advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm, and our show is a financial show. We call it Something More because we like to talk about all those important dollar and cents issues, but also those quality of life issues that make the money matters matter. And thanks for being with us. We're coming to you from our I almost said our WXTK. We're coming to you from our AMR studios today. We're here at the AMR offices, and glad to have you with us. Appreciate you joining us and tuning in. We're going to be talking about a variety of things today. This hour, I'm joined by Brian Regan, our firm's Chief Investment Officer. And Brian, there's been a lot happening this week in the markets, a lot of fear around banks and all that's happened. Last week, there were, I guess, actually 2 or 3 banks that we had that were either failed or taken over. And regulators have stepped in, had some policy responses. But it's still been a little bit of an anxiety-ridden week. And let's talk a little bit about first what's been going on with the banks specifically, and what gave rise to these kinds of concerns. And secondarily, is this like a widespread problem for people to be worried about when it comes to their bank?
Yeah, so I want to talk specifically. First of all, good to be here. Good morning, everybody. Sometimes I jump right into it and miss the pleasantries, but it's important. Yeah. So let's talk specifically about what happened at Silicon Valley Bank, because I think that was the most high profile one. It was certainly the biggest one. And honestly, it was also the most elemental, basic banking error I can think of. So
basic.
What's that?
So basic. I was just referencing the Anna, whatever the heck it was.
Yes. So was it the thing from the Netflix documentary?
Netflix,
there?
Yeah.
Was it?
Sorry.
Yeah, you did. That was a good joke. I wish I got it right away, because now it's awkward.
Yes.
So banks, on their most basic level, they take in deposits from customers, and you get all those services that we all like to use, like automatic bill paying, et cetera, et cetera, et cetera. And then they take those deposits and they invest them in a variety of assets. Now, what banks try to do, and I actually worked on a team in a bank that did this, is you try to determine which deposits are sticky. And by sticky, you mean, how long are they going to stay in with your bank? And there's a few easy ways to do this, right? You might notice that you get more perks from your bank if you do automatic deposit for your paycheck. And why do they do that? Well, they know that's a more sticky deposit. For a certain amount of time, they're going to have that in there every 2 weeks, every month, whenever, however often you get paid.
It is very true that people are very reluctant to change their banking. It's just there's an inconvenience about it, right? And so these are things that lead to that, you're saying.
But I'm saying what I'm really getting at is banks do a lot of things to make you want to stay there without raising the interest rate, right? So they just when I bought my most recent house, when I took a mortgage out with the bank, they forced me to open up an account. And why? Because I deposit money into that account to pay the mortgage every month, and that is a sticky deposit. They're going to rely on that every month. So they do all sorts of things to try to make your deposit sticky. What's the benefit of making your deposit sticky? Well, you can invest further out, right? If you know that money's going to be there for 5 years, for example, well, you can buy a 5-year asset, and you know that you're going to have the funding for that amount of time. Now, there's other assets that in banking we refer to as transient assets, which we are not confident that they're going to be there for any period of time. One of the ways that banks do this is you can just look at your biggest customers and you say, well, typically, this is the level of holdings they have. We have customer relationships. We understand that for XYZ reason, this level is probably going to hold. This is what's left over. And the leftover amount can be flighty. You're probably going to have to pay out the cash for those deposits. You probably can't invest in them long term. But the good news is you can leave them at the Federal Reserve. Every bank has a bank account with the Federal Reserve. You can leave those deposits with the Federal Reserve, and you'll make more money on the Federal Reserve than you will paying on the deposits. So you can even make money just on the transient deposits. You don't necessarily have to take a lot of risk. So ultimately, what this means is you just need to match your assets duration with your deposits duration. It's just very, very simple. What did Silicon Valley Bank do? Well, 93% of their deposits were not FDIC insured. So by definition, they're less sticky, right? People will be more nervous if they have to, if there's any threat to the bank, there's more likelihood of a bank.
Sure.
So, a big mistake there is by investing longer term than your deposits are. And that's essentially what happened. They should have been keeping those accounts within 1 year, or even at the Federal Reserve is the safest way to do it. But you could argue that they probably got a little greedy when
trying to make
very low.
So we had that's Silicon Valley Bank, but the Fed was it the FDIC who sees the bank when it comes to
FDIC does.
Yeah, when it came, there was a couple other banks that had issues. That one being the one in New York. What is that? Was it Signature Bank? What was different about that by comparison?
I don't think there was much different. I think they were very similar.
Same kind of issue. Okay.
And then so I just want to. Sorry, go ahead, Chris.
Well, ultimately, I just want to get to. Is this something that as listeners are thinking about this with their local banking environment, should they be concerned? And maybe you can talk a little bit about the Fed and Treasury response to some of these issues, or did you want to finish something else before going on to those things?
No, I think that's a good lead into what I was going to say anyways. So, what happened was that the bank had unrealized losses on these assets that they bought that they shouldn't have bought, right? It was a risk management mistake, a blatant one. So they went out to their clients and they said, they basically fell on their sword and said, we need you guys to stick with us, through this time, and we're going to raise more equity. And let's just say that the entrepreneurs, the venture funds that were working with Silicon Valley Bank, they did not work with them. They were not patient, and they started pulling their money right away. Which we can have a debate whether it's the right thing to do. I think it's completely understandable why they did that. I think if I was in the same situation, I would probably do the same thing, just because this becomes the life or death of your individual companies. You need to make payroll. You might be asking, why would these companies hold more than the FDIC insured limit? Well, they're business accounts. Oftentimes, if you're making payroll, for example, you might hold far in excess in the bank in order to disseminate the checks.
Yeah.
So this stuff happens, and since this bank specifically catered to venture funds and venture portfolio companies, they were naturally seeing a decline in assets anyways as the venture market dried up. So what can they do as people start to withdraw deposits, which was happening before the bank run? Well, they can do a few things. They can sell assets, and if they're properly matched, let's just say it was at the Federal Reserve, no big deal, right? You take it from the Federal Reserve account, you hand it to your customers, no problem. But if you went out and you had bought assets that had declined in value, which is what happened with the longer duration treasuries, you can only sell them for, let's say, 87 cents on the dollar. And your depositors have the right to 100 cents on the dollar. So this is essentially what happened. The company was underwater, had to fire sale their assets. The company closed down which was the right thing to do. The FDIC came in, they took over the bank, they guaranteed all depositors in this case, not just the limit. So that should give you, to answer your original question, Chris, some reassurance as to
I think that's really worth talking about. Like, first off, that the things worked the way you'd want them to, by and large. As much as people are, questioning, was there an issue with regulators? Should they have caught these issues? I don't know the answer to those questions, but clearly, I think you can say that depositors being made whole, certainly within the FDIC limits, that the bank stepping in, taking over the bank, the FDIC stepping in, regulators, that is the system working the way it's intended to work, and making depositors whole. Stock and bondholders, yes, you're going to lose money, but that's the way the system works. That's risk, if you invest in something that has more risk, right? So in any case, and then the fact that there's this, what do you think about the idea that they're saying, hey, even depositors that have in excess of the FDIC limit? This seemed like it was an attempt to prevent widespread contagion of this, fear that people are going to want to move away from banks that they don't have, fully insured assets.
Yeah, I completely agree with you. First of all, I think I fully support personally these moves made by the government.
Yeah.
What the FDIC did was beyond what they promised, but I think it was the right thing to do for exactly what you said, to prevent the contagion. The Federal Reserve also made a pretty significant step to stop a contagion. So I mentioned before that these bonds that Silicon Valley Bank had bought, that they shouldn't have bought, were trading around, let's call it 87 cents on the dollar. Well, a lot of times to get liquidity, banks do what's called a repurchase agreement, which is essentially a collateralized loan with the Federal Reserve. They say, take $102 worth of treasuries and give me $100 back. And they have liquidity, and they still own the treasuries, but the Federal Reserve has collateral. That is a normal course of action. But if your treasuries are worth 87 cents, the Fed's only going to lend 85 cents. So, that's why Silicon Valley Bank got in this problem that they couldn't get out of. But what the Fed did to try to stop contagion and try to stop this from happening with other banks, which I think is very, very powerful, is they said, we will lend up to par. So that means that even if the bond is worth 87 cents today, a market value, we know the treasuries and agency MBS are going to mature at 100 cents on the dollar, and the Federal Reserve will lend, assuming that they're worth basically 100 cents on the dollar. So that essentially,
that's a big help to these banks in this scenario, I'm sure.
It's a huge help. So if we say that they took too much duration on the asset side of the balance sheet, what the Federal Reserve essentially did was give them maturities of 1 year. So if they had a 5-year bond, they brought it into 1 year. So they helped the matching, in that way. I think that had, and with the FDIC implicitly insuring all deposits, you actually just extend the duration of the depositors as well.
Yeah.
So those two things should have a huge calming effect on these banks. It doesn't seem like behaviorally, we are at that realization yet. So maybe more will have to be done. But I agree with you. I think the government did exactly the right thing to do. I think Silicon Valley Bank will be sold at some point to a larger bank when they get some reassurances that, right now it's very unclear what the value of this company at, right? If there's no depositors, and you have the assets, and your job is essentially to make the FDIC whole at some point, right? You're really just a custodian of selling those assets as they mature at par. So that's why the bank hasn't sold. That's a separate issue, but I do think that these were very significant steps, and they should stem, losses, except for maybe at some of these banks that have similar exposures to Silicon Valley Bank. like it seems like First Republic does.
Yeah, that seems to be one that is in we're talking on Thursday. These things could change between now and then, be Saturday when we air. But First Republic is one that everyone seems to be watching as similar in structure to what's the problems that are happening at SVB, right?
Yeah, and they got some liquidity lifelines, right? So they're benefiting from what's called the bank lending program, which is what I just described with the Federal Reserve. That's a huge benefit. They're benefiting from JP Morgan had given them a lifeline loan of I believe $70 billion. But if the confidence in their bank is undermined to the point where the deposits are fleeing, well, they're essentially just paying out depositors, and even though they can make depositors whole through these lifelines, the bank is worth much less if it doesn't have any depositors, right? Like all your clients leave a business, what is your business worth?
And it sounds like they've made a business in working in like a high net worth market or with people who may very well have like otherwise uninsured, in excess of insured limits.
Yeah. I mean, I was looking into buying it throughout the week, just because, whenever you see any asset down like 85 cents on the dollar and the government stepping in,
yeah,
you gotta look, right?
Right.
And I couldn't personally get comfortable with it because I have no idea how many deposits have left this bank over the last 3 weeks. I'm looking at, anytime you're looking at a financial statement, it's in the past. And we all know that Silicon Valley Bank basically lost all its depositors within 2 days. So, I have no idea.
So one other thing we want to talk about is there's a lot of news about Credit Suisse this week. It seems like that's a slightly different situation. What was going on with that bank?
So this isn't new news. Credit Suisse has been just a garbage can of a bank for a while now.
We love it when you're plain spoken, Brian.
Huh?
I love it when you're plain spoken like that.
Yeah, I guess I struggle to soften some of these things sometimes, but no, it's been an issue for a long time now. One of the advantages of being a bank in Europe, though, is there's not many of them. They don't have widespread community banks like we have here. They also, all of their businesses aren't bad. If they bought a few investment banks over time, they have a fairly successful wealth management business.
Yeah.
Recently they actually spun out First Boston. So it seems like they're in the situation where they need to raise cash to support their banking business, which is having problems. But they have some good assets to sell, like spinning off First Boston, for example. But I do think they're going to need government lifelines as well, it seems like. And ultimately, I think they're going to be broken up and be a much smaller bank. Hopefully, there's enough support in the European Union and the Swiss Central Bank specifically to stabilize that bank. But this shouldn't be new to professional investors at the very least.
Yeah. We're going to take a break in just a second. Before we do we have any idea how long these extraordinary measures of, the extending of the FDIC insurance and some of these other efforts by the Fed and Treasury, how long are these going to last? And, as a consumer who might have money in a bank that exceeds the $250,000 or $500,000 limit, how eager should they be to resolve that issue?
Oh, I think you should do it right away. I don't think you should, unless you need to have it. I mean, so the FDIC, they guaranteed all the depositors at the 3 failing banks, but they haven't made like a wide sweeping
that every bank is
coverage fully insured. There is kind of an implicit, if they're going to do it to Silicon Valley Bank, why wouldn't they do it for your local bank? But we do know that, the government has made decisions like that in the past, the saving,
one versus another.
saving one bank or insurance company and letting another one fail.
Yep.
I was joking when this first started, and believe me, this was a big joke, that bank failures, and at this point in our lives, it just feels like a warm sweater, doesn't it? Like, it's just brings you back.
it does bring back, to your point, does bring back a lot of. I think that's partly why there's a lot of anxiety around this. It brings back a lot of memories, a lot of anxiety, and the whole worry of systemic failure, where banks are unwilling to lend to one another. Your take on whether that systemic risk has been managed?
So far, it seems like it's been. I mean, in my opinion, I don't know. So First Republic, for example, on Thursday morning, they declared that they're looking for a buyer. I don't think that they're not going to be able to meet their depositors' requests, but I don't think their depositors have confidence in the bank. So their business is just going to shrink to some very small degree, right? They might not necessarily need the FDIC to go in there and take them over. Maybe they will. Maybe by the time this airs, I'll be eating those words. But it seems like they'll have the liquidity to meet the depositors' withdrawals. The question is just, what's the entity worth if it has no clients, right? So I think those are two separate questions that you need to ask yourself. Is the system viable? Does it have the support of the government that it needs? So far, I would say yes. Is my individual bank viable? Can they meet the deposits? I would say yes. But is the business a good business? Still is a separate question.
Okay. Well, we have to take a break. I think, I agree with your earlier point that if you have in excess of the insured limits in the bank, one question is that the right thing to do? And the second question is, is there a way to manage that risk? Sometimes there is private insurance that banks offer, but is that as it's certainly not government backed in those situations? And I'd really look at, whether you want to diversify your risk a little bit. Let's take a break. And when we come back, Brian, let's talk about market response, stock bond market activity over the recent few days. And then we can also talk about what's been happening in economic developments, things, expectations around the Fed and so forth. We'll be right back after this. Stay with us. Welcome back to Something More with Chris Boyd. I'm here with Brian Regan, our firm's Chief Investment Officer. We're both with Asset Management Resources. Our firm is a registered investment advisor firm. If you have concerns about your financial situation, do you have the right amount in savings? Do you have quality investments? Have you got the right amount of risk to meet your financial needs? Not too much, not too little, right? Goldilocks, So trying to figure that out. If you have a need for a little bit of help in that type of setting, we can be a resource to you. You can reach out to us at Asset Management Resources. We're at amrfinancial.com. That's our website, amrfinancial.com. You can also reach out to us by phone, toll free, 866-771-8901. We offer a complimentary consultation and are happy to meet with you if we can be a help. In the meantime, we've been talking a little bit about the recent anxieties facing investors, particularly bank investors, what's been the cause of some of these issues, and how's the system responding? How are banks responding? Brian, you wanted to comment a little bit more about regulations, and then I'd like to go into how's the market responding. So why don't you pick it up with some of the things we were talking at the break you wanted to touch on?
Yeah. So like anything these days, I think people, get really political about it. And, on MSNBC, they'll be blaming the Republicans, and on Fox News, they'll be blaming the Democrats. And I don't think this is a Republican Democrat issue at all. Like most things, this is really, really poor risk management by the individual bank themselves, and the owners of that bank, the equity holders, the stockholders, are going to get wiped out. In this case, and the depositors are going to be made whole. In this case, I think the market regulated itself beautifully. I think that the government came in and did what they're supposed to do. People use the term bailout way too often. Nobody got bailed out here. People who had money at their bank got their money back. But if you were invested in the bank any way, shape, or form, you will get zero. And that's quite frankly,
Yeah, just to distinguish. So if you're a stockholder, if you're a bondholder, like that kind of invested in the bank, not necessarily saying you have money invested in the bank as a depositor. So there's that distinction. And I think that's exactly right. That, to your point, I mean, I think that's the way these things work. That's the nature of, capitalism. If you have investments that fail, you should fail, right? On the other hand, as a bank invested, we do have expectations of deposit, and this prevents a panic, of people, having so like perhaps exacerbating the problem and having it happen in multiple banks by taking these extraordinary measures.
Yeah, and I think there's just a lot of Federal Reserve hate out there for one reason or another. I don't understand why.
Yeah.
But I think there's like the automatic knee-jerk reaction of saying, where was the Fed? Well, you don't really know. First of all, they did exactly what they should have done in the aftermath. Second of all, this is a private business. How much do you want them regulating the private business? Third, like, what did you expect them to do? So the bank made the decision to go out further on the yield curve. Erroneously, they shouldn't have done that. I agree. Anybody with eyes would agree. But and the Federal Reserve might have asked them. I don't know, but maybe let's just say hypothetically, they went to the bank and said, why are you doing this? And the bank said, hey, look, we've been growing deposits at 25% a year for 10 years, which they had been. We're confident these deposits are sticky. Who's the Federal Reserve to say it isn't? There certainly was a track record there of that being the case. But I think now we know that there's a reality, and I blame the bank that they should have known. But
yeah, I totally get your point.
Yeah.
Sorry, look at you. Go ahead, finish your thought.
I don't remember what my thought was now.
I really want to just get on to things about glean. What are some lessons investors should glean from how things have moved? What's obviously the stock market has kind of had some jitters over what this implies. Your initial commentary to our team had some thoughts about a deflationary effect that this could have. What do we expect when it comes to how this is going to have some consequence, and how's it affected the way you're thinking about investments?
Well, I think the price of credit is going to skyrocket. All these banks are going to be much, much more careful when their clients are nervous. I think so. It's just not going to be as easy to get credit. We saw, the benchmark rates, the treasury rates fall significantly, which helps, but spreads are going to widen. Banks are going to want a lot more money for making the risk for making a loan, and in some cases, they're just not going to make the loan. So, if you wanted a construction loan, which is typically floating rate, you might have to post a lot more equity than you had to do in the past. You might have to pay a much higher rate than you had to do in the past.
Well,
if you want a new business loan,
much higher than they used to be, right? And that is seems like that's somewhat connected to what's driving some of these challenges. Is it just that we've got a lot of adjustment to consider when you have interest rates rise so significantly in a short period of time that there's these are ripple effects of this dramatic change in context?
Yes, but I think we're talking about two different things. The first question was about why this is deflationary, and it's deflationary because it's going to be much harder to borrow. It's going to be much more expensive to borrow. Yes, it was more expensive prior to this event than it was a year ago because of treasury rates, and I think that's what you're getting at, that they went up very rapidly. And this contributed to, hurting Silicon Valley Bank, for example, because if rates hadn't gone up so quickly, they wouldn't have been as underwater as they were. But that's a Silicon Valley Bank risk management issue. I'm talking about going forward. Why is this deflationary? This is going to constrain credit significantly because the cost of capital is going to go up dramatically. And this is the kind of thing that could lead to a recession. If we were looking at a soft landing or a Goldilocks economy prior to this event, now you need to absolutely price in the hard landing. That's the new reality that we're in, which is why you've seen rates crater, the treasury rates, benchmark rates. You've actually seen anything with a good amount of spread open dramatically as the cost of capital has gone up. So, I think what you're building to here, Chris, and correct me if I'm wrong, but what did we do in response to this?
Yes.
Is that where you want to go?
Sure, I'd like to talk about that.
Yeah. So if the cost of capital goes up dramatically, quickly, that means that the spread, the amount of interest that a lender wants on top of a treasury rate, is going to blow out. And that's really bad for your most credit-oriented investments. So I got rid of all our credit-oriented investments as quickly as I could, and moved in the investment grade investments. And the investment grade investments.
Why you did that? Just to put. I know you just go into more. Explain that further. Like why do we? I mean, we had high yield bonds paying 7, 8, 9%. We had floating rate bonds paying a yield of, I want to say it was around 8%. Which was significantly higher than what it had been just a year ago. So that sounds pretty attractive. You're more concerned with the risks of these are higher credit quality, higher risk to credit quality with these. So you're worried about more defaults?
If not more defaults, then definitely a higher cost of capital. And this is what I mean by that. Yeah. So I think even the casual investor has learned over the last year that as interest rates go up, bond prices tend to go down. Mm-hmm. Well, if you're in investment grade and you're just looking at treasuries, that you might feel good, right? Because yields have gone down, price of your bond has gone up. But let's say you're a company that can borrow, that needs to borrow money in the next year. Your borrowing rate, let's say, was 8, 9% prior to these bank closings. Let's say now they're 12%. So money that you were paying 9% on, you're going to have to pay 12% on. Well, what if your margins are only 3%, which is common for certain kinds of businesses? Well, that 3% could put you on the edge of a foreclosure and bankruptcy, like you said. So that would lead to more defaults. This happens, a 3% interest rate increase like that, basically overnight, is a lot. And I haven't looked at the spreads, but I know that they've gone up over the last week by a good amount. So there is going to be, there's two risks, right? The one risk is just interest rates going up. As interest rates on high yield bonds go up from that 9% to that 12%, you're going to lose price. Mm-hmm. The bond's going to be more volatile. There is a good chance, if you held the bond to maturity, you would still get your money back, but no guarantee. I mean, it does increase the likelihood of defaults as well. So there's that to consider. Now, in addition to that, we invest in funds more than individual bonds. Right. So when the fund has a bond mature, well, they're going to go out and they're going to reinvest at the new rate, at the new higher rate somewhere. So the fund doesn't typically act like an individual bond would, where you'd get the maturity and you have the cash and you can feel good about yourself and go out to the investment grade market maybe and buy something there. Mm-hmm. It's going to be reinvested into something in the high yield market. So if you have exposure in a high yield bond fund, the best thing to do is get out of it and go straight into the investment grade market rather than wait for that maturity.
And is when it comes to the investment grade market, elaborate on what you're envisioning there. Is this going to be an issue where by being in that, if there's additional rate decline, as you've seen in the market of the last few days, weeks, whatever the week, that's going to be priced benefited to the investor?
Yeah, absolutely. So, when you're looking at investment grade bonds, you want to look at treasury benchmark rates is a good way to determine, whether if you just look this, if you have a 7 to 10 year bond fund, for example, that's investment grade, and you just want an idea of directionally of whether it's going to be up or down, you can look at the 10-year treasury. The 10-year treasury rate's down that day. It's a good chance that your bond fund's up. When it comes to high yield, it's more correlated to equities than it is the 10-year benchmark. You actually need to look at the spreads. It's a little bit more complicated, but the investment grade market has been a big beneficiary to this new deflationary expectation that we have because of these bank failures. We've seen the 10-year treasury go from over 4% to south of 350 within a week, which is remarkably fast. This is not, I guess, not new to the market that we've seen this year, but that's very, very quick. And if you own investment grade bonds, which granted were very hard to hold, especially with any duration, because they were down 16% in 2022, and now they're rallying, off the charts just here in the last couple of weeks. So, if you own investment grade bonds as part of a diversified portfolio, you're getting some benefit now. Even as stocks fall, you're getting the diversification benefit. It's good to point out that that benefit that you weren't getting in 2022 to the same degree because they were positively correlated with stocks. Definitely seems like you're getting that now, which is a good thing because it's a deflationary scale.
I think it's also a point to make that circumstances change, and you've got to be willing to make adjustments and be prepared to know how to respond. If you find that in your to our listeners, if you're listening and thinking, I don't know that I'm getting that level of response and activity, certainly give us a call, see if we can be a help to you. You can reach out to us through our website, amrfinancial.com. We're going to take a quick break and come back, and let's talk a little bit about speculating about what's happening with the Fed, CPI, all that kind of stuff. We'll be right back after this. Stay with us. Welcome back to Something More with Chris Boyd. I'm talking with Brian Regan, our firm's Chief Investment Officer. And Brian, in such a fast changing times, it does leave investors sometimes wondering what's next. How do I be positioned in a way that's appropriate for my temperament and my willingness to endure risk? And I think some of the things you were discussing in the last segment really illustrate how active management can add value, and there can be times, last year we wanted to have shorter duration, and there was a real benefit to trying to have shorter term bonds in an environment that's changing. That may not be the case today, and you may want to extend duration. You may want higher quality instead of high yield in the mix. In any case, there's all these considerations that investors need to be attuned to. And if they're not getting that help, reach out to another firm if it's helpful. I think one of the things that there's been some speculation about is how's this changed the Fed's stance? A week ago, people were expecting Fed might raise rates 50 basis points, to try to deal with inflation concerns that are still an issue. What's the latest that's been happening? You said something about CPI. Where do we stand right now, and what's your take on what should we expect?
Yeah, so the most recent CPI number was good. It fell again from 6.4% to 6%. Food and energy are again keeping it higher. We're seeing food come in at plus 6%, and plus 9.5%, and energy coming in at 5.2%. Energy is really being driven by your utility bills. So those are probably going to fall in the second half of this year if natural gas prices stay similar to where they are. So we can discount that a little bit. Food's obviously a problem. It was significantly hampered by the avian flu issue, where the price of eggs and chicken increased a good amount over the last couple months. But we know that the energy prices are going to fall a lot over the next few months, as recorded by the CPI, because energy is down year over year. It's actually much lower today than it was prior to the invasion. So, that's going to come down over the next couple of months. We're seeing, durable goods. We're still seeing disinflation there, as the chairman mentioned many times in its conference. And I do think that we're definitely seeing some decreases in rent in the real time data that's not reflected in the CPI. So I think this is all goes to show that we're still moving in that direction, where we expect CPI to be dramatically lower by the end of the year, which I think is a good thing. It's a welcome reprieve from the inflation that we've had over the last couple of years, and certainly these new banking issues are going to be deflationary, and maybe accelerate this process that's already in place. Probably too much, and to a negative degree. So what does that mean for the Federal Reserve? Well, they had a very strong jobs number in January. It was strong in February, but less strong. It was a report that made more sense. It kind of confirmed a lot of hypotheses that weather had caused some big differences in the seasonal adjustment in the jobs in January and February. Wages came down closer to 4%, which is a more reasonable long-term average. So all that was good for the Federal Reserve on the wage and job front. We saw new claims tick up last week, which was the first seeing that in quite some time, as that thing has just been stuck on rock bottom full employment for a long time, which is a good thing. I don't like seeing people lose their jobs. But to me, it looks like the Fed has a lot of cover not to raise rates at all. These arguments that I hear about, they have to raise 25 basis points for credibility. I truly don't even understand the argument, Chris. Maybe you can shed some light on it. The Fed doesn't necessarily need credibility to me. They hold the sword. If you're not going to believe the guy with the sword, then
they constantly say, they're data dependent. And isn't this data? You know what I mean? Like to say there's been a changing dynamic with what's happened this week with the banking scenario and some of these kind of issues that if there's some influence on how this may play out in affecting the economy, I don't know, strikes me as they can pause. I think they don't. I think the worry is, you tell me, you're probably more in tune to this. They're reluctant to give the market too much enthusiasm because they're afraid that will exacerbate the inflationary trends, right? And they seem to be trying to talk down, expectations so that it, a lot of times just what they say can move the market, right? So it seemed to me like a lot of their efforts have been aimed at trying to position the market with expectations, and maybe it's not exactly how it'll play out.
Yeah, so the way I look at it is they have, for monetary policy, they have a dual mandate, right? They have stable prices and full employment. They have full employment, probably too full, and I don't really think they have much inflation anymore, and it's moving in the right direction. So
that's not to say, just for our listeners, that's not to say that we're saying that 6% inflation is palatable. It's what you're saying is it's coming down, whether we see it today exactly or just give it time. there are forces that are driving inflation to be more historically normal levels.
Yeah, exactly. So like, shelter costs for this month, year over year, is 8.1%. And we all know this is just a measurement issue, that the shelter prices are likely actually negative.
Yeah.
So,
Maybe you say we all know, not everyone knows that, but I follow your point, that if you understand the how these measures are calculated, you kind of perceive it differently.
Yes, this is a lagging data price. It's at least 6 months old. It's probably 6 to 12 months old. And I would agree, 6 to 12 months ago, it probably was rising at 8% year over year. Now it's not. I mean, we have real-time data for this. So if you discount that, you can drop 3 to 4% from the CPI probably. I mean, it's like 50% of it's 35% of CPI. So you take out, that gets you to, 3.5 to 4. And then we know that food and energy, we know energy is about to fall off a cliff. It's probably going to go negative. I'm just saying, like, the real number is not really 6. The CPI adjusted numbers, it's in the 3s. And trending down.
So it may not be as worrisome. So anyway, let's hope that does lead to perhaps a pause with the Fed. Just as an aside, I did see a news bulletin that came in that First Republic is there are talks being had with some of the bigger banks about possibly taking over one of these more smaller banks that's in question that we were talking about earlier. When it comes to maybe thinking about how do these issues affect your financial planning, your portfolio management? How should you be positioned for interest rate considerations when it comes to the Fed and all that's happening in the markets? When it comes to thinking about the type of stocks that you own and the risks involved? We had a conversation this week about a client who had 75% in a single company. And as much as it's never palatable to pay taxes, that's a lot of risk, even if it's a great company. There are times you got to take some assessment and get some help getting perspective. If we can be that for you, we'd love to talk to you. You can reach out to us through our website, of course, amrfinancial.com, but you can also send us an email at radio@amrfinancial.com. You can give us a call at 866-771-8901. If it's easier, text us. Send us a text, 508-915-3700. And of course, you can connect with us through our social media. With that, we're going to take a break for the news, and we'll be back with another hour of Something More with Chris Boyd. We're talking about demographics and their impact on portfolios and the markets. Stay with us. We'll be right back.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.